This is Mitch, and welcome to the 1000houses.com podcast. I'm here with Lane Kawaoka, and we're talking about passive income and how to live where you want and invest where you will. And he's out there in Hawaii right now as we speak. It's very early in the morning for him. So I'd like to say good morning to you, Lane.
Hey, thanks for having me, Mitch. Aloha.
Aloha. Yeah, and I'd like to pay homage to my sponsor, taxfreefuture.com. If you do not have a tax-deferred or tax-free retirement account in which you can grow your finances, please check out taxfreefuture.com. We're talking about IRAs, 401ks, health savings plans, educational savings plans, all that give you a tremendous tax advantage. You will not believe what your financial advisors are not telling you. We're going to tell you what they're not telling you. We're going to tell you why they're not telling you. And then you can do with what you want to do with the information, but I think you're going to find it very interesting. All right, Lane. So give us a little background. You look like a young man. How old are you? Where did you come from, and how did you get where you're at?
I am 34 years old, and I have 3,500 units currently today, mostly apartment and mobile home parks. And but I started back in 2009 when I bought my first rental property. Couple years out of college. I was an engineer, did this working a day job, and started with single family homes. My first one was in Seattle, $2,200 a month rent and $1,600 PITI mortgage. And to a young 20-something-year-old kid, that was all of your money. And because I didn't like my job, that was where it all started, because that motivation to rinse, wash, repeat, keep doing it over and over again was there to kind of finally quit the day job, fire the boss.
Okay, so where I'm from, that would have been an expensive house. Probably in Seattle, that's just a run-of-the-mill house, right?
Yeah, a lot of mistakes, right? Like the first rental I bought was a A-class rental, and it was in a primary market. And those are two big rules that a lot of cash flow investors, they don't break. Right. So breaking those down for those people, like you don't buy in places like Seattle, all of California, the East Coast, Hawaii. The rent to value ratios just don't work. You're not going to be above that 1% threshold. And then, just more of a, A-class, that high end, we try and stay away from. We also try and stay away from the war zone properties, but going after good, solid C and B assets.
Okay. So, man, hats off to you. Starting so early, being 34, having 3,500 units to your credit. And also, it's probably accidental, but I'm going to assume because we just do this stuff when we're ready, or was it planned? 2009 was a perfect time to go in and start buying stuff. It was right when the crash was happening. You got in right at the beginning of the crash. So, there was more than average opportunities out there, right?
Yeah, I bought the first rental, like I said, in Seattle, and then I bought a duplex in Seattle a couple years later when I was able to save together another 30, 40 grand to buy the next one. But then, around 2012, the prices kept on going up and up and up in Seattle, and I was like, what the heck, I can't cash flow. And then I realized, yeah, you dummy, you can't cash flow at places like Seattle. So that was when I was kind of forced to go to the Midwest and the South. So I bought eventually 11 rentals in Birmingham, Atlanta, and Indianapolis. Places where the rent to value ratios were well above 1%. And then I had to be a remote investor at that point, working through my property managers.
So were you in Hawaii have you always been in Hawaii when you started investing in other parts of the country?
I was up in Seattle. I was working up there.
Okay, so the first one you bought where you were at, right?
Yeah.
Okay, so you don't just wake up one morning and go, hey, I'm going to do real estate investing. So where was the aha moment? Who did you study? What did you see? What pushed you in that direction?
I had this big house that I was kind of proud of for about 6 months as a 22-year-old kid. And because I was traveling around for work so much, it was 100% travel. I was only home on Saturdays, and it was kind of stupid to have this big house to myself. So I was like, screw it. I'm just going to, call up my old landlord from college, have him rent it out for me, and just kind of lived off company expenses for a good couple of years. And that was where I got that first taste of cash flow. And that was kind of, again, where I was realized that if I just rinse, wash, repeat, did this again and again, I'd be out of the rat race.
So you kind of took notice of your college landlord. Was he renting houses out by the room, right, for college students?
Yeah, well, I mean, there were like 4 or 5 of us in there. But I mean, I did remember that they would come over on like a Friday or Saturday night to go unclog the toilet or check up on some repair. And then the poor guy had to, like, you know, Seattle's always rainy and cold, right? So his poor wife had to wait inside the Mercedes outside. And then, you know, it's just what didn't make sense, right? What is this guy doing, right? But this is what most landlords do, right? They do all their dirty work and they think they're trying to save money. But really, you know, if you want to scale and you want to do it the right way, you want to use property management. And yeah, you're going to have to pay them, you know, 10% of the rents and more when you lease up a new tenant. But that's what the pros do, right? I mean, I think 80% of single family homes are owned, you know, by landlords that only have one rental property. You know, there's a clear difference in mentality shift from landlords to investors. Why, you know, only 80% have just one rental, and why the other 20 guys they can scale 10, 20, 3,000, 5,000 units.
It actually gets easier the more units you have, right?
Right.
In one concentration, one place.
Yeah, but part of that is, like, you know, if you have a rental property up in a primary market, look, your numbers don't work. You don't have that buffer to go pay a professional to manage it for you. So I get it.
Yeah. So how do you pick a good management company? Because that could be a do or die choice, right? You have a bad management company, you're paying for things you're paying for something and then it's not even any good. So
yeah, I mean, I've got like a list of 25 questions on my website, you know, to ask, right, to do an interview style. But I tell all my guys, like, look, just go off referrals. You know, there's no reason to recreate the wheel here. You know, if someone's done well for somebody else, then use them. Maybe have a mini interview. But, like, you know, like, I think the problem is most people have bad experiences with property managers because they're going and using just random guys, and those random guys are typically coming from the big brokerage houses like a Century 21 or whoever, and you're just getting the fool who can't sell houses. So they can't do their real job. I mean, so property management is tough, right?
Yeah, it's an art. If you're good at anything, it's an art. You know what I mean? You know, it doesn't matter what it is. If you're the best at something, it's a fine art. It doesn't matter what it is. So you have family, you have children?
No children yet, married.
Okay, what's the average day? You're 34 years old, got 3,500 units. What's the average day in a life of Lane look like?
So I normally wake up, you know, not too early, right? It's not like I have to wake up for a job briefing at 5:30 in the morning anymore at the construction site. I wake up around 7 o'clock, check emails. You know, I got to talk to my clients and my investors for a couple hours via email. And then, you know, just a little bit of operations, a little bit of investor relations, and then, you know, create my podcast. And that's pretty much, you know, a lot of time blocking, just a whole bunch of stuff, right? I mean, the life of an investor.
So you have a podcast?
Yeah. Simple Passive Cashflow.
What's it called?
Simple Passive Cashflow.
Simple Passive Cashflow.
So I started it back in 2016 as a means to, so I have to repeat myself all the damn time to my friends who are asking me, well, how do you buy all these properties out of Birmingham? You don't even like visit it? Like, I don't get it. And, you know, you tell your friends what you're doing. Nobody does anything, right? Very few people take any action, especially today. And I'm like, well, I created this podcast. You want to just go check out the first 10 podcasts all about single family home remote investing. There it is.
Yeah.
Very few of them did it.
You can save your breath, right? There you are, you know, handing them the keys to $1 million fortune. And they're like, okay, I won't watch that. But it's not, you know, just like everything else, it's not for everyone. It certainly helps if you have a lot of passion for whatever you're doing. And if if real estate investing is not your passion, probably just as well you go find something else, because
Right.
it's not going to be any fun for you. So you do some you do coaching and have a giveaway for the listeners here today. You have 3 modules of your eCourse that you're giving away that has to do with passive investing. So describe a little bit about these 3 modules and what they can expect.
Yeah, so a lot of this, like this wealth building dogma out there is just a bunch of garbage, right? Go to school, study hard, work at a job for 40 years. Things like retirement accounts. Like I don't do any retirement accounts. I want my money out of the system now. So the government effectively has a lien on all retirement accounts. They can tax it. They can kind of change the rules however they want to tax it and get the revenue out of it. And this paradigm shift that for a lot of investors, you're going to retire or need that money or want to spend the money well before you're 40 or 50 years old. So you don't want to wait till you're 60, 65, and then look at all the stimulus plans. Like how else is the government going to pay it? But it just inflate the money supply. So taxes are going to also be going up too. So I'd rather pay my taxes on it today. And especially a lot of my investors, we go into like private placements and syndications where we're doing cost segregations on the apartment complexes. So we're getting huge bonus appreciation on it. And you can't get any of that unless if you're investing in a self-directed IRA or retirement account.
Yeah, so you said bonus depreciation or appreciation?
Bonus depreciation.
Yeah, depreciation. So you're accelerating depreciation on different things. So if we followed you around for a day, how are you locating opportunities all over the country? First of all, where do you pick to go, and then how do you mine in that area?
Yeah, so I mean, there's a lot of pieces to this puzzle, right? I mean, one thing I don't do well that's very critical to any investor is building relationships with brokers. Because in our world, the commercial world above 100 units, deals, especially because we go after stabilized deals, we don't go after, hairy messes like 60%, 70% occupied or less. These deals are controlled by brokers. So you got to be buddy with the brokers. And I don't like to do that personally. So I have partners that are kind of on the front line for that.
So you're not buying properties that you need to turn around. You're just buying properties that are already stabilized and they're going. So, I mean, my experience with that, like looking at those deals, mobile home parks, mini storage facilities or self-storage facilities, and apartment complexes, man, they're only offering these things at like 5 or 6% cap rates. It seems like that everybody wants to just allow you to make 5 or 6% if they're telling the truth about their numbers, which I never believe anybody's numbers. You have to go prove out everything yourself all the way to the very end, right? So how does that work, or how does that make sense that you can buy things, or are you still getting them somehow at steep discounts?
Well, I mean, you're not getting steals, right? But you can find bargains out there, that's for sure. And then the nice thing about this strategy is that you can get the Fannie Mae, Freddie Mac non-recourse debt, which is kind of the gold standard of loans out there. And
okay,
I don't like to take chances these days.
So you're talking about that kind of money kind of makes it easier to make money, right? Because you're borrowing money for 40 years. Tell me if I'm right. I just was talking to someone about this yesterday. They were getting money for apartments, 40 years fixed at like 3.5%, money.
Yeah, I mean those are the HUD loans. I mean HUD closed on a deal maybe like a couple months with that loan. So you have HUD loans are at the top. Those are those 40-year amortizations, and you have Fannie and Freddie loans. They're kind of tier below. There's good and bad why you would choose one or the other. The HUD loans, the difficult thing is it takes like 6 months to originate the loan. So you got to tie up the property for that long. So that's the bad thing, and it's kind of costly. But the Fannie Freddie loans, you can do your traditional 2-month close on that. Still pretty good interest rate, 30-year amortization. But yeah, I mean, we're more in the business of buying stabilized assets that we can put maybe $4,000 or $5,000 of rehab into each unit. So new flooring, new appliances, but we don't really get into the big stuff like countertops. So we're just looking to pop the rents $100 per unit, 10%, 15% lift on the rents. And I don't really care about like what the incoming cap rates are. So if I buy it at a 5, I don't really care. All I care about is what I can do to increase it, right? What's the delta? So if my rents are originally like 550 going in, and I know that if I do a market survey, it's already at 600, that's instant value right there. But if I do the rehab and I, make it all nice, improve the community, and I can get 650, maybe even 700, now that's where you can double investors' money in 5 years.
So in 100 units, say 100 unit complex, how long does it take to make that complete turnaround, to go through every unit and get them up?
Yeah, I mean, most investors kind of know this intuitively, right? Like your tenants typically move out, and 80% will probably move out in a couple years, right?
Yeah, so you're just dealing with them as they come available. You're flipping them, you're turning them, and then increasing the rent.
Right. It's a hybrid strategy, right? Like, I mean, we're kind of balancing both doing the business plan, getting people out, and rehabbing the units, but we also want cash flow too, right? So we're cash flowing too at the same time as all this is happening. So, I mean, in the summer months, people are a little bit more, turnover is a little higher. So you're doing a little bit more units. So like on, just take a good sample size of 100 units, you might have in the slower months, maybe a few of these units coming up for turnover and you're rehabbing the units. But in the summertime, it might be, 8, 12 units, right? But the idea is you go through most of them in the first couple of years, and then you're using the next couple of years to stabilize the asset in terms of people want to buy these off a trailing 12 or 24 month P&L. So you have to stabilize the balance sheet.
Okay, so this doesn't sound unreasonable. It sounds like, given the way you're talking, you're not looking to steal anything. You're just looking for you're trying to find this certain window. How many deals do you typically look at before you pull the trigger on one?
I mean, it's probably like, most of them are just garbage, right? Like 99.9% of these deals are just garbage that, some Californian would buy, right? And they're, typically paying 10% plus than what we would. But yeah, you're sifting through, the haystack, right? For sure. I mean, I don't know if it's 100. It's somewhere between 100 deals or 1,000 deals. And
okay, so I just wanted to impress on people. Like you just don't go out there today and say I'm going to get one this week. You gotta put up the numbers, just like pretty much everything else.
And the nice thing, what I like about it is like it's totally different from single family homes. There's a barrier to entry here. You can't just call up a broker and say, hey man, give me a deal. Like hell, they're not going to do that, right? The broker wants to close the deal. They only want to sell or present good deals to people who have closed multiple 100-unit deals in the past. So you have to have people on your team, and Fannie and Freddie won't even give you a loan unless you have previous Fannie Mae, Freddie Mac experience. So it's total cheat, right? Like it's a closed loop. If you don't have experience, you can't do one.
So I guess in that case, you'd have to partner with someone who had the experience, right?
Right. So it just spins the herd by so much. So it definitely is getting more competitive these days, but it's something that's out of reach of most, investors.
How is COVID affecting your rentals?
Not one bit. I mean, normally we're collecting at 97% collections. As everybody knows, you're going to have a few deadbeats out of 100. Mm-hmm. So, April, May came along. It maybe dipped down to 95, and then maybe at like 92, 93% at worst. But we're right back up. Some of the assets actually collected even better through COVID, like in Huntsville, for example.
Why is that?
I think just great market, right? You got to pick your markets well, because then it can kind of debunk the over macro trend.
One thing that's different in a pandemic than a recession is in the recession, the blue collar worker was probably knocked out way because banks stopped loaning money and then the building stops. But in this pandemic, these blue collar workers are deemed essential workers, right? So they're working and they're booming. I feel this too in my business. I sell about 70% of my houses with 30-year fixed 10% mortgages. No balloon, no requirement to requalify or anything. I don't want them to requalify. I just want to make their 30 years worth of payments. And what's happening is, I sold 18 houses in the last 2 months, and picked up like $250,000 in down payments. And I'm selling my houses to the blue collar workers, the air conditioner guys, the electricians, the plumbers, the carpet and floor guys. They're all booming because apparently people are going home to work. And while they're sitting there, they're getting tired of looking at that rotten deck or whatever. And they say, well, while I'm here doing this, I'm going to call this guy to fix this deck finally, and I'll be able to be here and watch them, you know? And so, man, the blue collar workers are booming. So I would imagine if they're booming for me to buy my owner finance houses, that they're out there quite capable of paying rents too. So even if you may have a deadbeat or someone falls off, you should be able to fill it with someone who's primed for a rental, right?
Yeah. I mean, I think, talking to my other apartment investor, cohorts, some people are affected more, right? Like, I mean, to kind of peel back the onion a little bit, blue collar workers, you can have guys, working at Burger King or Publix or Safeway. Those guys they're good, right? But if the restaurant worker doesn't have, they're more of like an upscale restaurant that are closed, or, like a meat packing plant or like a big processing center, those guys might be out of work, right? So it's hard. I think overall, like lesson learned from the last 6 months is like, we're transitioning away from some of the harder Class C tenants, because a lot of these guys, they just don't have $500 in cash savings.
They can't float. They can't even float 1 month, right? So that's, well, we did the same thing in the owner finance houses. We started buying a little bit better quality house in a little bit better quality neighborhood, so that when there was a hiccup in the economy or something, these people could take a 3-month hit and they'd still be able to pay their bills and stuff. But in the lower, like you said, Class C or D, one bump in the road and they can't pay, and you're off, finding another replacement. So talk to us about some of the digital courses that you offer.
Yeah, so I've got the Grandmaster Suite of passive investing. I mean, there's a few hundred hours of content in there, split up in different modules. But I think this one I've been creating recently is specifically for remote investors. It's a relatively short course. It got step by step to guide yourself through your first few rental property buying remotely. So if you're buying a turnkey rental or trying to do it out of state, it's perfect for you. And then another one for guys who don't have too much money or looking for a little, trying to play some small ball, trying to scrape up $10,000 a year doing this, is trade lines. So you can put people on your authorized user slots on your credit cards that you're not using, or maybe you're using them, and you can pick up, $100, $200 a month from each person. It's kind of like a rental property, except there's no down payment.
Well, there you go. Well, I want you guys to go over to 1000houses.com/lazy income and check out what he has to offer. Pick up your three free modules from his eCourse and that are dealing with passive investments. Check it out. See what he's got. I think we can all agree. You got a 34-year-old young man here on a call that has 3,500 doors. He knows something. And there's a lot of people out there, and a lot of y'all out there that would like to be in his shoes. So why don't you take this time, take advantage of his free offer, go over to 1000houses.com/lazy income and check it out. And also maybe check out his podcast, Simple Passive Income podcast.
Simple Passive Cashflow. That's the one.
Simple Passive Cashflow. There you go. Thanks for correcting me. And check it out. Who did you study, or did you just figure this stuff out? Did you do the School of Hard Knocks, or did you get under someone's wing?
I mean, I bought first, and I kind of learned through just kind of doing it. I mean, when you're a passive investor and there's not much to do, right? Like the property manager runs the day-to-day. And it's my first 5 years, I was just buying rental properties, buy and hold that cash flow. So it wasn't like I was taking huge risks, right? I still don't really take big risks today. I mean, it's all stuff that's income positive.
How did you start out funding your deals?
So I had a good paying job, right? So a lot of my clients are high paid doctors, lawyers, engineer. My highest and best use and their highest and best use is at their day job. unfortunately. That, they may not like their job, but, you got to do what God gave you, right?
Yeah, yeah, right. And so I have a course myself on raising private money. I have about $26 million out in the street probably as we speak. And it's the same thing. The availability of a reasonable cash and terms makes the whole world go around. So do you teach, well, you'd have to, you have a section here about raising capital or raising private money or partnering?
No, I don't do that. I mean,
You know?
if you want to go, pay all these other gurus like 30, 40 grand, I mean, I'm sure they love to take your money, but I specifically cater towards, accredited investors looking to be passive, right? Like you're not going to be an underwriting specialist, but you're going to know the questions to ask and what to look for so you don't go into sucker deals. And, I have like a mastermind where you build your relationships with other passive investors, which, like I said earlier, like referrals and relationships are really what drives your investing when you get above $500,000, $1 million net worth.
So can they find information about your mastermind over there in the show notes?
Yeah, that'll be in there. And then, but if guys are accredited, reach out to Mitch, and I'm sure Mitch can kind of screen you guys and send them over. Right. I mean, we are a secret society. Make no mistake. This is the Bat Cave right here.
The Bat Cave. Well, man, my friend, thank you for getting up so early. It's quite a time difference from where I'm at and where you're at. I thank you for getting up early to be on. Again, you guys go to 1000houses.com/lazy income and check out your 3 free modules about passive investing, and also check out all the digital courses, what he has to offer, and learn how to do this remotely. I mean, if you live in a place like San Francisco, California, or New York, or someplace where things just don't really seem to mesh with this kind of investing because of the properties are so expensive, learn how to invest wherever you want to and live wherever you want to. There are people out there doing it, and if they can do it, you can do it. It's just the difference is their mindset and their knowledge, and both of those you can obtain if you want. So get out there and get with it. I'd like to thank you, Lane, for stopping by. And we'll talk to you soon. Anything you want to say to the investors out there before maybe we wrap it up?
If I like people who take action. If you're gonna, spend the time, listen to my first 10 podcasts, trying to get your first rental property, I'm totally willing to get on the phone. Just take some action. Put a little work into it. And just email somebody out of the blue and say you want to take somebody's time.
Yeah, put in some work, man. He's offering all this free stuff. At least you say, yeah, I've already been through all that stuff. I have some questions. All right. This is Mitch Stephen, 1000houses.com podcast. I'd like to thank my sponsor, taxfreefuture.com. You won't believe what your financial advisors aren't telling you. So check it out, taxfreefuture.com. We're out of here.